want to trade US30. Maybe you've seen people get big profits, flip accounts, or how much money you can make with the 0.1. Or you may be like me. When I first started, I saw a guy on IG flip 900 to 100K in 3 days trading US30. My vision board is filled with US30 profits for more experienced traders than me. For a long time, I had pages of 3 figures, 4 figures, 5 figures, 6 and 7 figures profits in a day in my vision board. I've made it to 5 figures in 1 day. I haven't hit 6 figures yet, but about 2 years ago, I decided to focus on mastering US30. And since then, I've made 6 figures from US30 alone, as well as passed all of my prop firm challenges that I took in the last year with US30 alone. In this video, I'm going to share with you how I trade US30 so that you can make a transition to trading it or another index like SPX 500 or NAS 100, or pick up some ideas you can add to your arsenal. In this video, I want to cover 4 things. Number 1, what is US30? Number 2, what moves it? Why does it move? Number 3, the strategy that I use day to day to make money. Number 4, how to increase your current win rate with US30. Now, what is US30 and what moves it? US30 is a stock market index that represents the performance of 30 large publicly owned companies from different sectors based in the US. Think about an all-star basketball team. The leaders from each team, the leaders from each sector are placed in the US30 index. Now, why does US30 exist? It is in the name index, which literally means it is a measure of something. It is one of the widely followed stock market indices because it is used as a measure of the overall health of the US stock market and the overall economy. The index is calculated using a price-weighted method. The stock prices of the 30 companies are added together and divided by a divisor to produce the index value. Changes in the stock prices of the companies impact the overall value of the US30. Now, the 30 companies in the Dow are selected because they are considered leaders in their sector. Just think about the NBA All-Star game. You have the top 5 from the East and the top 5 from the West. And if they played seriously, we can use each team as an index to measure the health of the East and the West teams. So that's sort of the concept. The 30 companies in the Dow are selected because they are considered the leaders in their sector. If any of the companies are underperforming, a committee may replace it with another. I'm telling you this because if you're going to trade US30 and master it, you should know these basics. Now, what moves US30? It is important to understand what moves US30. Why is it so dynamic and volatile? Why do we love it? Why does it move so much? This is something that many people don't understand and makes it hard for them to trade it successfully. The value changes a lot for this reason. If the value of the companies within the index change, the value of the index changes. And the companies with the largest price, if they change significantly, it can cause the value of the index itself to change. Wait, you may be asking, why is this all relevant? I'll tell you in a minute. Just keep watching. So if we look at Friday, August 4th, US30 took a massive dump. Look at the top stocks with the highest prices. Apple, United Health Group, Home Depot, Goldman Sachs, and Microsoft, they all took a dump. On Friday, the drop of these top stocks caused the index to drop. Many times when we look at US30, we're looking at it like it's one stock, but it's very dynamic because the different stocks that make up the index can fluctuate in one day and cause a lot of fake outs and volatility. Now, why does this correlation happen at times, right? Because the prices of the equity stocks respond to macro events like interest rates, inflation, unemployment, etc., right? So depending on the macro events, an institutional investor may sell multiple stocks within the index, but this is not always the case. So US30 is very dynamic and very rewarding due to multiple factors that can impact the index on a daily basis. But 2 of the top stocks can be going in the opposite direction and cause the index to stall. And when this happens, you may not see the movement that you think you should. So now on to the strategy. Now, when people introduce strategies, they hardly ever mention this part. For the strategy to work, the instrument that you're trading must move. And in order to move, there must be a catalyst, something that causes it to move. Have you ever seen a candle like this with US30? This doji, there's no movement because there may be no catalyst. And there are 2 types of catalysts, fundamental and technical catalysts. In this video, I'm going to share a technical strategy that depends on a technical catalyst. For the earlier part of my career, I only had technicals. My trading was good, but I've increased my edge by also understanding the impact of fundamental catalysts. We won't talk about fundamental catalysts in this video. We will leave that for another time. Now let's get to the technicals. There are truly mainly 4 types of trades. I'll explain which types of trades my strategy works the best with, but the 4 types are trend continuation, trend termination, termination, support and resistance holding, aka the range, support and resistance breaking, aka the break and retest of the range. This strategy works with all four, but it's best used with the trend continuation, termination, or the break and retest of the range. So the strategy mainly is revolved around two words: supply and demand. If you want to see a full video on supply and demand, watch this video. Now, the basics of what you need to do is determine the trend first. Look for your supply or demand zones, and then shoot when price comes into your zones. What is the most challenging part of this? Determining the direction of the trend. But what is a supply and demand zone? Let's get into that. The supply zones are zones we sell from. It's called supply because a large amount of contracts will be sold from this zone. Supply refers to supply of contracts, sort of like a sneaker reseller holding a supply of sneakers to sell. We find these zones by watching for a period of consolidation followed by aggressive selling, a large push to the downside. This is the clue that is left behind for us to trade from the zone when price returns to it. Now, once we see this happen, we wait for price to return to that zone. Even if structure is broken and it appears to be reversing, going in the opposite way, we will sell from that zone when price returns to it, as seen here. Oftentimes, institutions can't unload their positions all at once, so they'll unload some of those positions, push price higher again, they'll push price back up to the supply zone, they'll get buyers in so that they can trade against them. That's why this is effective. This style happens very often. Now, what is a demand zone? A demand zone refers to zones where aggressive buying is occurring. Just imagine a large institution wants to purchase a lot of supply at this level. Like currently, the Chinese tech giants are rushing to buy as many of the NVIDIA GPUs as possible because there are concerns that the US could impose new export restrictions, right? So it is said that the Chinese purchases amount is 1 billion this year of those GPUs and estimated to be 4 billion in 2024. The demand is high because of the fear of the restrictions. So a demand zone is where we see a strong amount of aggressive buying. When these demand zones are printed, it is an indication that there is a strong buyer there that would like to buy a lot of contracts. So even if structure appears to be downtrending, when price returns back to those zones, you will be looking for buys, knowing that the institutions need people to trade from. They need liquidity. So oftentimes they will paint a picture that they are going in the opposite direction just to get traders in so that they can trade against them. We will look for tight periods of consolidation, strong aggressive buying, and then we will wait for price to return to these zones. And we will enter when price reaches the zones and gives us an entry confirmation. Now, here are a few examples. Okay, so here's a downtrend example. And as I mentioned, something that's very, very important is understanding what the higher trend is doing. We had a trend termination here. So the trend US30 was trending upwards, and then we had a reversal. And this zone is going to give us signs of areas where we can get sells in now that the trend has reversed. You see here, price moved up, and then we see a massive sell off. It's breaking this support right here. So price comes up, back up to this zone, and then we have a nice sell-off. Okay, here's another example. Again, understanding the catalyst, right? So we were uptrending, and here at the open of around the open of NY, we had a massive push upwards, right? So only big, large institutions can create movement like this. So we have a huge move up, and then price comes back down, and eventually back into this demand zone for another move up. And after that, we'll see price just move aggressively and continue to trend upwards, right? So these demand zones are critical zones that if we can identify them and we understand the direction of the trend, trade demand in the direction of the trend, it could lead us to high probability trades. So here's another example where price actually hit a resistance, started to reverse. We have consolidation, massive bearish push down, and then when price comes back into the supply, we have confirmation to enter into a trade for a nice 1 to 3. Again, understanding the context is very important, but just laying down the foundation for more videos on this topic. For this example, for context, the big picture, market is on an uptrend, and it broke a significant level. So we see consolidation here, massive push up. Only institution can do that. So when price comes back to this demand zone, we have a slight push up here. It fails, but again, we have confirmation for entry. Aggressive buying shows its hand at the open or near the open. Pre-market right before the open, we could enter into a buy back up to this level confidently. When you see the footprint of the institutions and you know the higher time frame context, these trades can lead to nice high probability trades with good risk to reward. So let's go back to catalysts. So here the technical catalysts are the zones. Once you identify those strong zones and they align with the trend, you can get high R&R moves. To increase your win rate in R&R, in another video we will talk about how to incorporate changing fundamentals. Now please like and subscribe. If you want a free weekly market analysis, join the Discord. I also have a free prop firm course for all who join Discord. If you want to see a more in-depth video covering supply and demand, watch this video.